My name is Michael Grandi. I'm a professor at Providence College, and this is going to be a YouTube PowerPoint presentation. The class is Accounting and Decision Making in Organizations. This is the Providence College MBA 603 class. And as I mentioned, this is going to be a PowerPoint presentation voiced over by myself, and specifically dealing with Chapter 1 from the Managerial Accounting, Garrison, Noreen, and Brewer book, Chapter 1. And as we all know from any textbook we've ever been involved with, Chapter 1 is the introductory material, and it surveys the entire semester. So many of the topics that we're talking about today is going to be a survey. It's going to be an overview of the material that's coming forward. Many of the concepts, many of the definitions that we discuss in this chapter will be foundational in nature and set the stage for the entire course. Paying attention, understanding these definitions and these concepts is crucial to understanding the material as we go forward. So what I would like to do now is share my screen and bring up the PowerPoint presentation, and we'll start this this discussion. Should be about 40-45 minutes long, and we will start from the beginning. And so Chapter 1, as I mentioned, this is the Garrison, Noreen, and Brewer book, Managerial Accounting and Cost Concepts. This is the 17th edition of this textbook. There is a fundamental difference between financial accounting and managerial accounting. Many of you who are taking this MBA program have had both of these classes. Your foundation classes involved ACC 203, which is financial accounting, and ACC 204, which is managerial accounting, and you began to see the differences. But financial accounting, as you well know, is more historical in nature. You spend all of your time recording transactions, because that's what financial accounting is about. Financial accounting is about learning how to record transactions so that you can prepare financial statements. And those financial statements specifically are the income statement, statement of retained earnings, balance sheet, and statement of cash flows. It tells the reader of the financial statements what happened. It's historical in nature. Managerial accounting is slightly different context. It is used mostly by managers within the business. Financial accounting is more about reporting information to external users. Managerial accounting is much more in depth, does not involve as many journal entries in the preparation of financial statements. It's more analytical in nature. Decision making is something that's really important within managerial accounting. It's about taking information within the company and making managerial decisions. As we're going to see as we progress through this, it is not historical in nature, it's prospective in nature. It provides a tool to project, to forecast, to estimate what we think may happen in the company based upon assumptions and formulas, not necessarily based upon journal entries and transactions. We have 5 real topics that we're going to take a look at here, and the first one is assigning cost to cost objects, accounting for costs in manufacturing companies. We're not talking about retail companies in this course. We're talking about a company that makes something from scratch and then sells it. A little bit about preparing some financial statements, and getting more into the nuts and bolts. We're talking about predicting cost behavior in response to changes in activity. Again, we're going to see a bunch of chapters where we are trying to estimate how the company will perform at certain levels of activity, and we really need to understand our cost structure. so that we can predict costs as we go forward. And lastly, we're going to see a couple of chapters on making business decisions based upon managerial information. So learning objective number 1 is understand cost classifications used for assigning costs to cost objects, direct costs and indirect costs. What are direct costs? What are indirect costs? Direct costs are costs that can be easily and conveniently traced to a unit of product or other cost object. Examples are direct materials and direct labor. Examples of direct materials are those significant aspects of a product. And the example that I tend to use in class is a company that manufactures desks. Not the IKEA type desk, but significant desk, you know, mahogany kind of desk that Father Shanley or Father Sicard would have in his office. And the direct materials in a desk like that would be the wood, the lumber that goes into that desk, the hardware, the pulls, the hinges. Those would be the significant aspects that go into that. Those are the direct costs. Those are the direct labor. Pardon me, that is the direct materials. Direct materials are the significant components of the product. Direct labor are the wages and salaries of the employees who assemble, who put together, who touch the product. Those are the classic examples of direct material and direct labor. Indirect costs are costs that cannot be easily and conveniently traced to a unit of product or other costs. And those primarily are made up of manufacturing overhead. And manufacturing overhead is made up of 3 general components: indirect labor, indirect materials, and other factory overhead. Let's talk about indirect materials with regard to our desk. Indirect materials are things that go into the desk, but we don't really keep track of. Nails, glue, and stain are some good examples of that. They go into the desk, we don't keep track of them, and they're not easily traced. We don't keep track of the number of nails. We don't keep track of the amount of varnish and stain that goes in there. They're considered manufacturing overhead, which will be allocated to our product. We'll see how we do that in later chapters. Indirect labor is another component of manufacturing overhead. And indirect labor, examples there are salaries and wages of employees in the factory that do not touch, do not assemble the desk. Supervisors, for example. Supervisor may be overseeing many people who make that desk but doesn't really touch the desk. Could be custodial staff, secretarial staff, security, employees within the factory, the manufacturing plant, but they do not assemble the product, therefore indirect labor. And then the third component of manufacturing overhead are these other factory costs, such as property taxes on the factory, insurance on the factory, depreciation on factory equipment. Operative word here, operative phrase being factory. All the other costs, utilities on the factory. These are all examples of manufacturing overhead. Manufacturing overhead is going to be allocated to our product, and we're going to see in a couple different chapters how that is done. Learning objective 2, identify and give examples of each of the 3 basic manufacturing cost categories. We talked about that a little bit. Direct materials, direct labor, and manufacturing overhead. Direct materials are raw materials that become an integral part of the product and that can be conveniently traced directly to it. The example given here is the radio installed in an automobile. In my example of the desk, I would say it's also the wood and hardware of the desk, traced directly to it. Direct labor costs are those labor costs that can be easily traced to an individual unit of product. Wages paid to the auto assembly workers. In other words, the wages and salaries and benefits of the employees who put together, who assemble, who touch the product. Again, the assembly line workers. Manufacturing overhead includes all manufacturing costs except direct material and direct labor. These costs cannot be readily traced to the finished product. They need to be allocated in some fashion to our product. Includes indirect materials, as we talked about, that cannot be easily or conveniently traced to specific units of product. It also includes indirect labor costs that cannot be easily or conveniently traced to specific units of product. Examples of manufacturing overhead: depreciation on manufacturing equipment, utility costs on the manufacturing plant, property taxes on the manufacturing plant, insurance premiums incurred to operate the manufacturing facility. Only those indirect costs associated with operating the factory are included in manufacturing overhead. That's crucially important. It's the factory. It's not the headquarters. It's not the sales room. It's not the corporate jet. It's not the fancy offices in the city. Difference between prime costs and conversion costs. Prime costs are the prime costs that go into my product, direct materials and direct labor. Conversion costs, how do we convert that raw material into a finished product? We need to convert it by labor and by manufacturing overhead. Some non-manufacturing costs. Okay, so manufacturing costs were direct materials, direct labor, and manufacturing overhead. Those are manufacturing costs. Now we're talking about non-manufacturing costs. Those are things like selling costs and administrative costs. If you remember your multi-step income statement, it began with sales revenue, and you subtracted your cost of goods sold. Cost of goods sold is your manufacturing costs. Sales revenue minus cost of goods sold equals gross profit. Gross profit less selling and administrative expenses equals income from operations. So you can see they go in different places on the income statement. Learning objective number 3, understand cost classifications used to prepare financial statements, product costs, and period costs. Product costs includes all costs that are involved in acquiring or making the product. We just talked about that. Direct materials, direct labor, manufacturing and overhead are our product costs. Product costs attached to a unit of product as it is purchased or manufactured, and they stay attached to each unit of product as long as it remains in inventory. So what's important to know here is that all of the product costs go into inventory until when? Until it's sold. Now you may remember the matching principle from financial accounting, and the matching principle specifically says you cannot expense the cost of your product until when? Until you sell it. So all of these costs associated with making our product, making our desk, wood, hardware, labor, manufacturing, overhead, all of those costs do not get expensed. They get put on the balance sheet until such time as we sell it, and then the cost goes into the cost of goods sold. For manufacturing companies, product costs include raw materials, work in process, and finished goods. Now, what's important to understand here is the definitions. Inventory is made up of 3 components in a manufacturing company. Raw materials. Raw materials are the wood and the hardware. They are materials that are in our warehouse that is untouched. Wood, hardware, nails, glue, paint, materials that are untouched. Work in process, again, another category of inventory. So raw materials consist of units of product that are only partially complete. So work in process, by definition, is started but incomplete. They may be in various stages of completeness. They may be 5% complete, 10% complete, 75% complete, 90% complete. Fact of the matter is they are incomplete. They are work in process. At some point in time, that product is going to be completed. That desk is going to be finished, all put together, sanded, stained, boxed. It's completed. The definition, a synonym for finished goods, is completed. It's still an inventory. It's just in another stage of inventory. It stays in inventory until such time as it's sold. Transfer of product costs. When direct materials are used in production, their costs are transferred from raw materials to work in process. An employee goes over to the raw materials inventory to acquire some wood and some hardware, some nails, some glue, and brings them over to his or her workstation to begin it. It moves from raw material to work in process. Direct labor and manufacturing overhead costs are added to work in process to convert direct materials into finished goods. Once units of product are completed, their costs are transferred from work in process to finished goods. And then lastly, when a manufacturer sells its finished goods to customers, the costs are transferred from finished goods to the cost of goods sold. That is when you expense the cost of your product. You move the cost of your product from finished goods to cost of goods sold when it is sold. Question is, what is the cost of that one desk? You need to move the cost of that desk or the number of desks that were sold. How do we know what the cost of that desk was? That's what we're going to spend several chapters trying to figure out. Cost classifications for preparing financial statements. We have product costs and we have period costs. Product costs include direct materials, direct labor, and manufacturing overhead. And as you can plainly see here, we build up the costs build up. As we work on that product, we have materials, we add labor, we add manufacturing overhead. All of those costs are on the balance sheet in a component of inventory, raw materials, work in process, finished goods, until such time it is sold, and then we transfer the cost to the income statement. When we sell that product, we make two journal entries. The first journal entry is to record the sale. Debit accounts receivable, credit, sales revenue. And at the same time, we record the cost of that product. Debit cost of goods sold, credit finished goods. Matching principle, matching revenue and expense in the same accounting period. Period costs include selling and administrative expenses, non-manufacturing costs. Let's have a quick question. Which of the following costs would be considered a period rather than a product cost in a manufacturing company? Now, more than one answer is acceptable here. Manufacturing equipment depreciation. That's a product cost. That's part of manufacturing overhead. Property taxes on corporate headquarters, not the factory. That's one of them. That's a period cost. Direct materials cost, it's product cost. D, electrical costs to light the production facility, part of manufacturing overhead. E, sales commissions, selling administrative expense. You can see the correct answers are B and E. Learning objective 4, understand cost classifications used to predict behavior. Now we're going to spend several chapters trying to estimate profit. What would profit be? Sales minus expenses equals net income equals profit, right? But if we're projecting and estimating, it has nothing to do with journal entries. It has to do with cost formulas and assumptions. How do I predict the cost? We have to understand how that cost behaves, how that cost reacts relative to activity. Activity is the number of units we sell. We have three types of costs: variable costs, fixed costs, and mixed costs. We need to understand what type of cost it is so that we can predict it. A variable cost, a cost that varies in total in direct proportion to changes in the level of activity, the number of units we sell or we produce. The cost per unit is always constant. Classic example is direct materials. Direct materials, let's assume on our desk that the cost of direct materials for wood is $100 per desk. Cost per unit is constant. Direct materials for wood is $100 per desk. Total cost depends on what? The number of desks we produce. So if it's $100 per desk and we make one desk, total cost is $100. If we make 10 desks, $100 per desk times 10 desks is $1,000. Cost per unit is constant. Total cost depends on the number of units we produce and sell. What's an activity base? An activity base is an allocation factor, is a unit of measure. It could be units produced, it could be machine hours, labor hours, miles driven. It is a measure of what causes the incurrence of a variable cost. Number of units produced, number of machine hours, labor hours, miles driven. In our example, it was number of desks produced. $100 per desk, 10 desks, total cost is $1,000. The activity base, the cost driver, is number of desks. A fixed cost, a cost that remains constant in total regardless of changes in the level of activity. Classic example, rent expense, rent on the factory. If the rent expense on the factory is $10,000 per month, it's going to be $10,000 per month, whether we produce one desk, 10 desks, or 1,000 desks. It's still going to be $10,000 per month. See the difference? A variable cost, $100 per unit. Fixed cost, $10,000 per month. If expressed on a per unit basis, the average fixed cost per unit varies inversely with changes in activity. So on a fixed cost, the total cost is constant, but the cost per unit varies, it changes, it fluctuates, depending upon the level of activity. Types of costs. The committed cost, a long-term cannot be significantly reduced in the short term, or discretionary may be altered in the short term by current managerial decisions. Committed, locked into it. I signed a 10-year lease at $10,000 per month. I'm committed, I can't get out of that. Discretionary, well, it depends, you might be able to get out of it. Skip that slide. Relevant range is important. So a fixed cost is only fixed over a relevant range. The relevant range of activity pertains to fixed cost as well as variable cost. For example, assume office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. So what it's saying here is that it's fixed per year only if it's only need 1,000 square feet. Fixed cost would increase in a step fashion at a rate of $30,000 for each additional 1,000 square feet. I'll give you another example of a relevant range. Let's assume that we're paying $10,000 per month for rent. And in that space, we can produce a maximum capacity of 10,000 units per month, working 24/7, 365, working around the clock, 24 hours a day, 7 days a week. We can produce a maximum of 10,000 units. It's going to cost us $10,000 per month. If we wanted to produce 15,000 units, we couldn't do it in the existing space. So we'd have to get additional space. We'd have to get more space, and the fixed cost would therefore jump to another $10,000. So it's only fixed to a certain level of capacity. Here's a nice comparison of cost classifications for predicting costs. Variable cost, total variable cost increase and decrease in proportion to changes in activity per unit. This is what you want to remember. A variable cost, the classic distinction is the cost per unit remains constant. $100 of direct material per desk. Fixed cost in total. Total fixed cost is not affected by activity, by changes in the activity level within the relevant range. In other words, the classic definition of a fixed cost is the total cost stays the same as activity changes. $10,000 per month for rent, whether we produce 1 unit, 1,000 units, 10,000 units, or 0 units, it's still $10,000 per month. Here's another question. Which of the following costs would be variable with respect to the number of ice cream cones sold at Baskin-Robbins? There may be more than one correct answer. So which ones are variable? The cost of lighting the store, variable? I don't think so. The wages of the store manager, he probably gets a fixed salary. The cost of ice cream, right? It depends on the number of ice cream cones we sell. Variable. D, the cost of napkins for customer. The more customers we have, the more napkins we're going to use. So C and D are variable. Now, we talked about variable costs, where the cost per unit is constant. For direct materials, I can predict a variable cost. If it's $100 per desk, I can estimate total cost. All I need to know is how many desks I'm going to make. If it's $100 per desk, and I think I'm going to make 10 desks, direct materials is going to be $1,000. I know the cost formula. Cost formula is $100 per desk. How many desks? I can predict total cost. Rent. As long as I know the rent is $10,000 per month, I can predict rent for any month. It's going to be $10,000 per month. Variable, fixed. But what is a mixed cost? A mixed cost contains both. A mixed cost has a fixed component and a variable component. In order to predict total cost, you need to know the cost formula. Again, we're trying to predict cost. This is not actual cost. We're not going to look at a journal entry and figure out what the cost is. We need a formula to predict cost. So a mixed cost has both. Utility cost is an example of a mixed cost. It has a fixed component and a variable component. The example I like to use is a hospital. And everybody's either been a patient or visited somebody. If there are 0 patients in the hospital, is there electrical costs? Absolutely. There's a certain level of electrical cost that has to be there. There are some lighting, there's some electricity for air conditionings, for computers, certain level of electricity use has to go. That's the fixed component. The variable component comes into play when the number of patients in the hospital goes up. If there's 1 patient, put the lights on in one room, another room, maybe you have to use an X-ray machine or CAT scan or whatever, you're going to incur electrical costs. There is an estimated amount of electrical cost per patient per day. That's the variable component. Because as patients come into the hospital, electrical cost is going to go up. So I need to know what the estimate is of electrical cost per patient per day. And then I can add it to my fixed costs. So what we're going to see is a formula here. The total mixed cost can be expressed with an equation where y equals a plus bx. Y is the total cost, fixed plus variable. A is the total fixed cost, $1,000 per month. B, the variable cost per unit, or in our example, the electrical cost per patient per day. That is a variable cost. By definition, cost per unit is constant. X is the key. How many patients am I going to have? Do I estimate I'm going to have 1,000 patients, 2,000 patients? Once I have an estimate of the number of patients that we have in our hospital, I can predict, I can estimate total cost for a cost that's mixed in nature. Remember, a mixed cost is fixed plus variable. Here's an example. If your fixed monthly utility charge is $40, that's the fixed cost, your variable cost is 3 cents per kilowatt hour, and your monthly activity is 2,000 kilowatts, what is the amount of your utility bill? $100, right? The $40 is fixed, plus the variable cost per kilowatt at 3 cents per kilowatt hour, multiplied times my estimated number of kilowatts. When we get to chapter 5, we're going to talk about that. Learning objective 5. Understand cost classifications used making decisions, relevant costs and irrelevant costs. Decisions involve choosing between alternatives. The goal of making decisions to identify those costs that are either relevant or irrelevant to the decision. To make decisions, it is essential to have a grasp of the concepts of differential costs and revenues, opportunity costs, and sunk costs. What is a differential cost or incremental cost? It is the difference in cost between any two alternatives. We'll see an example. A difference in revenue between two alternatives called a differential revenue. So alternative A versus alternative B. If I do alternative A, what's my revenue versus alternative B? Differential costs can be either fixed or variable. What is an opportunity cost? The potential benefit that is given up when one alternative is selected over another. Opportunity cost. These costs are not usually found in accounting records, but must be explicitly considered in every decision. For students, what is the opportunity cost you incur by attending class? Maybe you could work, right? Had a job. If you're working, you get paid $20 an hour, but you're in class. You're not getting paid. So a lost opportunity is an opportunity cost. By you being in class for 2.5 hours, rounded up to 3 for commuting. By you being in class for 3 hours, you're not able to work. $20 an hour, 3 hours, you lose $60, a lost opportunity. The $60 becomes the opportunity cost. That's the way I like you to remember it. A lost opportunity equals opportunity cost. What is a sunk cost? Sunk costs have already been incurred and cannot be changed now or in the future. These irrelevant costs should be ignored when making decisions. Sunk costs, something that happened in the past. You can't do anything about it. Suppose you're trying to decide whether to drive or take the train to Portland to attend a concert. You have ample cash to do either, but don't want to waste money needlessly. Is the cost of the train ticket relevant in this decision? In other words, should the cost of the train ticket affect the decision of whether you drive or take the train to Portland? Is the cost of the train ticket relevant? Absolutely. It's a relevant cost in your decision process. Again, suppose you are trying to decide whether to drive or take the train to Portland and attend a concert. You have ample cash in your pocket, but you don't want to waste money. Is the annual cost of licensing your car relevant in this decision? No. You paid that. You paid that licensing fee 2 months ago. It's a sunk cost. It's also irrelevant because whether or not you take the train, you still pay that cost. It's not relevant. Suppose that your car could be sold now for $5,000. Is this a sunk cost? No, it hasn't happened in the past. It's something that could happen in the future. A sunk cost is something that happened in the past. Last objective, prepare income statements for a merchandising company using a traditional and contribution format income statement. We're going to see more of this in chapter 5. Look at this income statement. The one on the left-hand side is what we call the traditional income statement. Multi-step income statement. Sales less cost of goods sold equals gross margin, less selling administrative expenses equals net operating income. In other words, sales revenue minus product cost equals gross margin, less non-manufacturing costs equals net income. Used primarily for external reporting. It's what you learn in financial accounting. But look on the right-hand side. Contribution format income statement. Starts and ends with the same number, doesn't it? Sales revenue is still $100,000. Net operating income is still $10,000, but it's a different format. We have now broken down the costs of cost of goods sold and selling administrative expenses between those which are variable and those which are fixed. Sales revenue minus variable expenses equals contribution margin. Contribution margin is that margin which you have to offset fixed costs equals net operating income. Contribution format income statement is a tool that we're going to use to make decisions on how to improve the profitability of our company. And we're going to see more of that in chapter 5, and then later on when we get the cost, volume, profit. Uses of the contribution format. The contribution income statement format is used as an internal planning and decision-making tool. We will use this approach in these chapters: cost, volume, profit, chapter 5, segment and reporting profit data 6, budgeting in 8, and special decisions, make or buy analysis in chapter 13. Well, there you go. That's the end of chapter 1. I certainly encourage you to read the chapter in chapter 1 so that you get a more thorough understanding of these definitions. So thank you very much.